This Week in Economics on the 11th of November 2017 from WBRN Radio in Boston and on the Bostonred Network. We roll along here. We'll look first at some PMIs. We usually like to do this from the make sure I get the name right, the IHS Market People, that is the Production Managers Index. And let's get to one for the U.S. We'll start with this, and there's also a projection out from the New York Fed. We'll get to it. Where will oil pricing go? We'll talk about that, and we'll get to $90, $100 by Christmas. We'll see that, the Christmas holiday, and of course an effect obviously on consumers if that happens. Nonetheless, this particular one is November the 8th. Technology sector signals strongest growth in over 3 years. And the key points here: fastest upturn in tech output since September 2014. Consumer service firms indicate stronger growth. Weak performances among consumer goods firms, despite pace of expansion accelerating. The U.S. technology sector signaled a steep output growth in October, as according to the latest U.S. sector PMI data from IHS Market. The pace of expansion accelerated for the third month running since September 2014. Overall, it was the highest-ranked sector in terms of growth performance. The financial sector continued to expand sharply despite growth rates easing for September. Overall, the sector indicated the second quickest upturn. Consumer services signaled a further increase in output levels, with firms in the sector reporting strong and accelerated growth. Production in basic materials sector continued to grow in October, but the pace of expansion has softened from September's strong rates. Following modest output growth in September, upturns in consumer goods and healthcare sector accelerated and were solid overall. That said, the rate of increase were weaker than the long-term series average for both sectors. As for consumer goods and healthcare, it's from Dr. Williams. He's the chief economist there. So basically, if you look at these particular sectors, let's see, right, around 50, 56, 60, almost 62 technologies: financial, consumer services, basic. We talked about that. Individuals, of course, at about, 50, 54, 52. Healthcare, a little less than that. And consumer goods, that's the U.S. sector. Let's move on here to the Europe sector PMI, where they are. Basic materials and banking driving a European growth in October. Strongest rise in basic material output since December of 1999. Fastest growth in banking activity since February of 2006. Sharp declines in tourism and recreation activity in over 4 years. And the latest Europe PMI data shows basic materials registered the fastest growth of output in September. This was the first time it has topped the broad ranking in nearly 4 years. Overall, the rate of growth was the strongest since December 2099. Other broad sectors monitors registered strong expansion, except consumer services, which was the bottom-ranked service in 13 consecutive months. Overall, the strength of financial activity was driven by banks, which saw their fastest growth since September 2006. It was followed closely by detailed sector ranking, machinery and equipment, technology equipment, respectively. Together, these remain the three fastest growing detailed sectors over 2017. The relatively weak performance of consumer services mainly reflected a renewal decline in the activity in the tourism recreation sector. Output has declined 5 times in 2017 so far, with the latest contraction the sharpest since July of 2013. So a little different there, a mixed bag, so to speak. The market Eurozone retail PMI, headline retail PMI, falls to 51.1 from 52.3. Sales down on an annual basis. Input inflation sharpest in over 4.5 years. September saw the 7th consecutive month rise in like-for-like sales of Eurozone retailers. This was the longest period of growth in 11 years. The expansion was broad-based across the big 3 Euro economies. That said, the rate of growth eased and weakened, and weaker increases in France and Germany, and was slightly overall. The headline market economic, Eurozone PMI, which tracks month-to-month changes in retail sales in the bloc's biggest 3 economies combined, dropped to 51.1 in October from 52.3 in September. In contrast, sales were down on an annual basis, therefore reversing the upturn seen in previous surveys. From Alex Gill, mixed messages were signaled by the latest survey data as the health of the Eurozone retail sector. On one hand, like-for-like sales rose for the 7th consecutive month, the longest sequence of growth since 2016, combining the further increases in employment and purchasing activity. On the other, the rate of sales expansion eased, while the decline was registered on an annual basis. Taken all together, the data continues to paint a positive picture of the Eurozone retail sector given the post-crisis. Actual sales of Eurozone retailers continue to fall short of previously set plans at the start of Q4. The degree of the shortfall weakness from September, but remained in market overall. The discrepancy between actual and predicted sales remains widest in Italy, followed by France and then Germany. Gross margins facing Eurozone retailers continue to be squeezed at the start of Q1. The rate of decline remains marked, despite easing marginally from September. Contradictions were recorded in each of the big 3 Eurozone economies, with the sharpest in Italy, contributing to falling margins was another rise in average input price. Moreover, the rate of inflation quickened to a 57-month high and remained substantially greater than the long-run series average, and increases reported in each of the 3 monitored countries, led by Germany. Meanwhile, weaker monthly sales growth contributed to a slow rise in purchasing activity. Needless, the current period of expansion at 7 months represents the longest sequence of growth since the financial crisis, and in turn the contributed, I don't know why I said that, to further build-up of stocks of goods. Finally, in spite of a slowdown in like-for-like sales growth, firms took on additional staff members at a sharp rate during October. That said, the rate of job creation remains weaker than the average over the past 24 months. Not the best sign there in the Eurozone. It's going to be kind of interesting. Now, this is the German PMI, retail PMI. Sales rolling modestly month over month. Sales slightly lower than a year ago. Margins squeezed by a sharp by the sharpest increase in purchase prices since 2012. German retailers recorded the slowest month-on-month sales since June. In October, with sales down slightly over the same period 1 year ago, according to the PMI. There was a return to growth in retail employment, which had fallen for the first time in over 7 months. But the businesses in the sector face the steepest rise in purchase prices since March of 2012. Seasonally adjusted headline German PMI was 3 months lower at 51.2 from October, down from 52. Year-on-year basis of like sales were down slightly. Retailers underperformed relative to their sales targets, again in October, in line with the trend observed in every month since May. That said, the gap between actual sales and planned sales tightened considerably since September and was the narrowest in 4 months. Meanwhile, retail expectations towards future sales and performance showed a sharp involvement with a degree of optimism, the highest since April. Factors expected by survey respondents to support sales in coming months included a generally improving economy and more aggressive marketing. Conversely, the factors seen as potential threats to sales outlook included the impact of the diesel scandal, unfavorable climate conditions, and reluctant consumers. Reluctant consumers are always there. Germany's latest data shows a renewal increase in the level of employment in the retail sector. That's in Germany. Levels of spending on goods for resale by retailers rose for the 7th month in October. The rate of growth picked up to the fastest since May and was slightly above that seen on the average year to year. Meanwhile, October saw further intensification of cost pressures facing retailers. They are having accelerated to the 4th month, running to be the highest since 2012. Steep rising costs linked by survey respondents to higher prices paid. Commentary here from Phil Smith, principal economist. The retail sector performance dropped at the start of Q4, as the PMI shows. Month for like sales growth eased to the lowest since July. There was also bad news for retailers in terms of costs, which rose sharply during the month, adding to the squeeze on margins. The survey offers some cause for optimism, however, with firm growth in growing in confidence and future sale performance, and getting back into hiring mode after a drop in employment in September. That's Germany. Hold on here. The Nikkei sector PMI, software and services output, a rebound in October. Metals and mining's worst performance as South Asia sector data compiled again by Market, sponsored by Nakira, indicates expansion in output of 13 of 19 monitored. A sector, software services was the brightest, and services the brightest spot in October. Sharp increases in new business recorded in the sector history supported an upturn in the output. The rise followed a contraction in prior survey period. General industry recorded the second strongest rate of output growth. Automobiles and automotive parts, which registered decline each of the 4 prior months, returned to expansion territory. Solid growth in outputs is recorded in chemicals, transportation, pharmaceuticals, biotech, and beverage and food. Currently, a modest increase was observed in the technology equipment category, consumer services, machinery and equipment, healthcare services, construction materials, only slightly expansion in activity over the month. At the end of the neutral 50 was metals and mining, which slipped to the bottom position after recording the sharpest contraction in output. The rate of reduction was in fact the fastest decline in the business activity, fastest decline since June of 2016. Forest and paper products has slipped to the second bottom, and commercial and professional services, banks, and real estate were only marginal. And finally, output in household and personal products, insurance sector stagnated during the month. And so much for Japan. Things are not rosy there. Spain, we thought we'd look at Spain in light of Catalona. Activity increased and ongoing new order growth, rate of job creation accelerated. Sentiment dropped to a 13-month low amidst the uncertainty around Catalona. The Spanish service sector remains comfortably in growth territory during October, seeing the market increase in activity and new business as well as a fast pace of job creation. That said, the rate of expansion in business activity was the slowest since January. Reports that political uncertainty in Catalonia, that is Barcelona, dampened growth. Similarly, business confidence dipped to the lowest in just a year. The headline seasonally adjusted business activity index posted 54.6 in October, down from 56 in September. Output has now risen on a monthly basis for the past 4 years. The latest expansion was marked, but the slowest since January. Central to the latest increase in output was rising client activity and strong market conditions. On the other hand, some panelists indicated that the political situation in Catalonia restricted growth. The expansion activity was widespread across subsectors. The fastest was posts and telecommunications, followed by transportation. New business continued to increase sharply during the month. The main factors for input prices to increase, hotels and restaurants signal the fastest rise in input costs. The passing of higher cost burdens to clients has led to a rise in output prices, with some companies indicating that improving demand has strengthened their pricing power. With new orders continuing to rise, service providers signal another monthly increase in outstanding business. Moreover, the rate of acceleration quickened for the second month, coming to the fastest since July of 2015. Companies responded to pressures on capacity by taking on extra staff. In October, employment has risen for 37 consecutive months. Excuse me. The investment in commercial terms is set to support growth in business. Companies remain optimistic that output will increase, although sentiment dropped to a 13-month low again for Catalonia. Input prices rose sharply over the month. Inflation quickened to since April. Panelists indicated that higher staff costs was the main factor leading to the increase in hotels, restaurants, etc. Overall, the comments here from Andrew Harka. Overall service sector performance improved again in October. The Spanish economy maintains a solid growth trend. Particularly pleasing was the was the pickup in rate of job creation. That said, events in Catalonia again acted to dampen growth, with the impact of the service providers greater than seen for manufacturers in the same sister PMI. There were reports of clients delaying spending decisions, probably were decrying them too, on uncertainty, while business sentiment dropped at its lowest in over a year. That is indeed Spain. And let's move back here. Talking about petroleum oil pricing, hedge funds pile on bullish on bet as Mideast tensions heat up. Money managers boost Brent crude long position to record. Short sellers take position to the lowest in 8 months. Hedge funds betting on rising Brent crude prices hit a fresh record as tensions in the oil-rich regions, talking about Libya, Nigeria, Venezuela, in the past months. According to Mr. Morris, one of the commentators was saying that these didn't amount to very much at all. Political risk has been small scale. Michael Lynch, he's president of Strategic Energy and Economic Research in Worcester, Mass. By telephone. How else would we be talking? But when you are talking Saudi Arabia and Iran, that gets people's spirits flowing well. Saudi Arabia and Iran not only a chunk of almost 11 million barrels of oil of crude and more than 40% of production from OPEC. In the shocked world, Saudi Arabia's ministers and billionaires were arrested in the anti-corruption drive by the Crown Prince Salman. He's consolidating his power. The Lebanese prime minister, a pro-Saudi politician, abruptly resigned. He's supposedly on a house arrest in Saudi Arabia. Anyway, who knows? Hedge funds raise their long positions, and from month to month, contracts are increasingly trading at a premium to later dated ones, market structure known as backwardation. That signals a strong demand. Brent futures for December of 2018 were $2.19 higher than the December of contracts. Hedge funds raised their Brent long positions in the difference between a bet on a price increasing and a wedge on a drop by 2.4%. A record 543,069 contracts. That was the end of the week of December. That's data from ICE futures in Europe. A long surge by 2% overall. We use ICE here. The record position is not surprising because when you think about it, nothing has changed either fundamentally or sentiment-wise to take away this bullish attitude. That's from Ashley Pearson, lead analyst at Stratus Advisors in New York. I wouldn't be surprised to continue seeing this kind of a movement as long as we are not getting any negative news from OPEC. Well, we never know. And that's the caption headline here was oil above $80 before Santa Claus holiday. That's very unusual to see that happening. Millions of barrels, $71, $80, $85 there. Brent crude closed more bullish in 11 weeks. Well, again, this is far the kind of stuff that comes out there. Where it goes, very difficult to say. This is from Bloomberg. I will look at Bitcoin, plunged after plans for split called off. look at the oil market here. I've always kind of been fascinated with petroleum. I hear this Jeffrey Summers on the 9th of crude. Markets around the world denting oil's long stretch of weekly rallies succumb to pessimism. The arrest of those royals in Saudi Arabia, they've been thieves for a long time. We're waiting to see what will happen over the weekend with the Saudis. That's for Phil Flynn, a senior analyst at Price Futures Group in Chicago. Interesting, they don't talk about phone. Crude has surged about 35% since reaching its 2007 NIDEC in late June. Global suppliers have tightened at the end of the month. The Organization of Petroleum Exporting Countries is expected, and this is talked about by Mr. Morris, expected to extend output curves beyond their March expiration date to further erode the oversupply that triggered a 3.5 year rout. Earlier this week, the kingdom advised its nationals to leave Lebanon. Well, don't worry about that. West Texas Intermediate, T-Boone Pickett and Company. Delivery slid 43 cents to settle at $56.74 a barrel. That's on the New York Merc Exchange, capping the week's advance at about 2%. It's the longest streak of weekly gains since October of 2016. The total volume traded was about 14% below the 100-day average. Oh boy. The shale revolution, 11.5 million gallons of water. We'll have to read that one later. Brent crude settled, dropped to 41 cents, settled at $63.52. We'll get that in the BBC, but this is way too high. Here, Mid-East tensions, well, not much there. The American crude production jumped to 9.62 billion barrels last week, according to the Energy Information Agency. Stockpiles in the world's largest economy unexpectedly increased last week. Shale drillers boosted their rig count by 9 to 738, as according to Baker Hughes, because Baker Hughes has been sold. Anyway, Iraq will export between 30,000 and 60,000 a day. The Kirkuk fields to Iraq via truck until the Iraqis finish setting up a pipeline. Global refining capacity is likely to stay structurally tight midterm. So any drop in margins is a buying opportunity, according to an analyst at Merrill Lynch. The operating rate at China independent refiners rose to 66.46 of industry capacity, the highest since 2016. So a lot of good information here. That was from Ben Sharps and company at Bloomberg. Let me just jump back here. The BBC, of course, the summit in Vietnam, and DJ Trump is winding down, as one would say, period there. And what else do we have? Not a lot of, from the BBC, and not a lot of news. Thus, we will jump to the markets. It's on Friday, unless otherwise noted. The BBC, whoops. Oh, I'm in the wrong one. Sorry about that. It should be. What has happened to us? I want to get to my... Oh, here we go. The BBC Global 30 in negative 108.60. These are Friday, unless otherwise noted. The FTSE All Share at negative 24.34. In Amsterdam, they were at negative 3.05. In Frankfurt, the DAC was at negative 55.09. A lot of red. All this is Friday and all this negative. In Paris, they were negative 27.03. And in Brussels, negative 17.23. In Madrid, negative 48.40. In Zurich on Friday, negative 43.66. In Moscow on Friday, negative 14.35. In Johannesburg, negative 294.82. In Bombay, actually in a positive, 63.63. In Karachi, 531 on Thursday in the positive territory. In Lahore on Friday, negative 45.11. In Colombo, negative 14.48. And in Tehran on Wednesday, 14.30. Excuse me, in the positive range. In Sydney on Friday, negative 18.10. The Nikkei at negative 187.29. And the Hang Seng at negative 15.65. In Shanghai, 4.88 in the positive. The Dow in New York, a negative 39.73. The Nasdaq was actually positive at 0.89. The Merck was down negative 2.32. In Sao Paulo, 1,046.17 in the negative on Monday. And in Mexico on Friday, negative 648.42. Now on to the commodities. Finally here, Brent crude. We gave you some of the Brent crude stuff, but Brent crude futures on Friday was down 30 cents at $63.63. Brent crude on the spot was down 20 cents at 58.59. West Texas Intermediate was down 30 cents at $56.87. T-Boone picking and jumping for joy there. Even a $15 bill, which is probably where it is about now in 70s prices. The Forex Gold Index down 50 cents at $1,284.30. Dubai Gold Futures down $12.50 at $1,275.80. Silver was down 10 cents at just $17. The Euronext Life Futures, cocoa was down 80 cents. Robusta coffee was up $27, or up 27 anyway. The Bloomberg Commodity Index on Wednesday, 85.59. So that was the Bloomberg Commodity Index. All Midway East Drive rally dented by global market sell-off. This is on the 10th. I think we covered this, did we not? Yeah, we did. Anyway, Saudis purge, simmering tensions, some sell-off activity. We got through the rig counts. We got through all of it, basically. This week in economics on the 11th of November, 2000. Oh, we need to do the Fed. Excuse me. Somewhere here, it's hiding from us. Not certain. Oh, well, oops. No. Here we go. New York Federal Reserve. And I need to do a little fixing here, as one would say. Nowcast report. Get it in here. This is a nowcast for Q2 nowcast model here. It's the Fed's nowcast at 3.2%. That is where they think growth will go. I'll append this to the report here. People were jumping for joy on it. Let me just get an overview here. Hopefully we can get an overview of the nowcast. Our model produces a nowcast of real GDP growth, incorporating a wide range of macro data as it becomes that. The week ending on November the 10th, 2000. That's from the New York Fed. And let's see. We'll grab the PDF of the current report. We've not looked at it. Here we usually do like to look at things first. But you can't see everything. Yeah. Basically the same. Basically the same thing. Oops. Our model produces a nowcast of GDP, incorporating a wide range. We went through that. What's the strategy the platform employs? The Kalman, filtering a technique and a dynamic factor model. So we'll put all this up there. What are the input data? We include market moving indicators, the same data also constantly monitored by market participants. Should you trust this? Extensive testing, etc. there. So it's there. Yeah, you can trust it. How should we read? The model forecasts all variables taken into account, their dramatic interactions. The difference between two constant forecasts, that is the forecast revision and the weight average there, basically. News is defined as the difference between released data and a model predictor. So some references here you can go to and find out more about it. We started reporting the nowcast for reference a quarter about 1 month before the quarter begins. Precise data are related to the Commerce Department's schedule for the official GDP releases. For example, we began reporting the nowcast for 2016 Q1 on November 20th, 2015, and so forth and so on. And anything else they have to say? The New York Staff nowcast and the Atlanta Fed GDP now are based on statistically filtered techniques applied to dynamic factors. These techniques are very common in a big data analysis. Yes, they are, since they effectively summarize the information contained in a large data sets rather than small common factors. The general framework for macro nowcasting has been developed in the academic literature over a decade. Q&A included there. The staff nowcast is a straightforward application for advancing for the most advanced techniques developed in academic literature. So in other words, they're falling back here on established academic literature. Anyway, it's now at 3.2 is where they are going here with their forecasts. And let's see, related readings. Well, do you forget? Anyway, the Library Street. This is June 2017. So there's some things you can read. We'll have to check that out there. We're always interested in that sort of thing. But remember, 3.2 is the optimum there. And I think we already threw the PDF up there, so you really don't have to worry about it. If you look at November 2, actual at 3%. And again, kind of interesting here. The latest estimates of GDP, housing, construction, manufacturing, surveys, retail and consumption, income, labor, international trade, and others, where they are. And we'll look at that. Job openings, some other interesting things here. Anyway, we will append this to our report, and let's see where we are going. This will be ending on the 10th, so it was ended yesterday. So we're in good shape as far as that is concerned. We'll add this to our, I guess what you'd call library here. Nonetheless, have a good weekend, everyone. And for those in business, next week, a productive one for consumer with the holiday retailing, what there is of it, coming from the Amazons of the world, and some of the big box, or perhaps the small box now, like the Best Buys, the Targets, Sears will keep their stores open, so there should be some bargains there, and they will be shutting down right after the holidays. And I suppose what we used to call in the old days the after holiday or after Christmas sales will be the closing sales for many of these operations. That's Sears, Kmart's, some Targets are closing. You see reductions across the realm. Some redundancies at the GE software division are coming about. And noticed some of the other information technology people, some consolidations. So we'll be watching that to see in terms of the head count, where that is going. Will it be a similar situation as we reported some of the PMIs out of the Eurozone and some other, particularly in Germany? The head count is up, but will head count start as in the UK? I don't think we reported the UK, but head count in the UK is beginning to be in exposure, let's just say that. How will the tax machinations in Washington affect things similar to Brexit and Catalonia? Well, that's kind of in the air right now. One version, they would do the corporate tax cuts next year. One version would be limited corporate tax moves to the 20% there. What they'll do about bringing money back in. And the Paradise Papers out there, they even found Queenie herself had a little dough stashed away in a piggy bank offshore. So a lot of these people there, and what's happening in Saudi Arabia. But there's been a lot of rampant corruption going along there for a few decades. Many lower line prince sheiks and what have you there that happen to have hundreds of millions of dollars stored away somewhere. In other words, all this money, I suppose, will be recouped, and these characters, I don't know if they'll be in jail or beheaded, but the whole thing is they will stock up this Saudi sovereign fund. Now, this is an attempt by the Saudis to have a $1 trillion plus fund. I forget what the exact figure is now, where they will have a very large fund, and they'll be able to as we say, wheel and deal on the international level with many of the larger players out there, i.e. the U.S., China, etc., that have large sovereign funds. So this has a meaning, and what does the surge in petrol prices mean, say, for the Russian Federation? They'll recoup some money they have lost in the next few months. And Venezuela will recoup money lost there, and all the oil-producing countries that can get themselves online. It only takes a few months. Now, part of the problem is, with a caveat, as these prices, and I've noticed petrol, gasoline prices rising. I didn't do an average here, but we will in the U.S., that puts pressure on discretionary income, which will put a further pressure in a Q1 on retailers, but didn't make it or only marginally made it in a Q4. So in other words, how many large screen TV sets you buy in those mobile devices, etc., do people buy? If they buy in November or in December, they normally will not buy in January. And also winter clothing for the winter, all that stuff will go out there, and we'll be waiting on spring and summer. So it's kind of a situation. Q1 has always been a transition period, and in the quote-unquote older days, it was a period between the Santa Claus holiday and early January that some of the factories in manufacturing were on hiatus. And also it's the same situation that happens in the retail trade. Stores vamp up. Kmart this time around, Walmart would just be using the workers they have, which they'll run those into the ground and not add additional workers. Other people will add additional workers, and of course they will leave those posts right after the holidays. In other words, before January 1 or slightly after January 1, depending on how that is set up. And of course you'll look at the Sears Kmart places, they'll be leaving either in January or February, many of those stores permanently. So in other words, that will start to push up the redundancy or unemployment levels somewhat. And then these other things will add on. We'll just have to see. But Q1 is very tenuous, and also it can be affected by adverse climatic conditions because you have January, February, etc. in there. We don't know at this point if it would be as significant, say, as the hurricane season was, but these things are sort of built in, plus the amount of discretionary income there, and we'll be looking at such things as credit card borrowing, which has been pushing consumers so far. But if consumers are pushed with their discretionary income, further with gasoline price hikes, what about the tax situation? Even with tax returns, which what happens there is, I don't know if they'll get this tax bill through retroactive, some of it. People that get, say, quote-unquote, a larger return, they will immediately spend that, and that will go into the economy starting more in Q2. Yeah, in Q2 than in Q1. But we'll see. Have a good weekend, everyone. We'll talk to you next week. Good day from WBRN Radio in Boston and on the Bostonred Network. Numbers Man on the 11th of November, 2017.